Think about your day so far. Maybe you started it with a cup of coffee from your favorite cafe. You tapped your card, and just like that, money left your account. Perhaps your paycheck landed in your bank account this morning, a welcome sight that boosts your balance. Or maybe you just paid your monthly rent, a significant chunk of money moving from your control to your landlord's. These are all financial transactions, simple exchanges of value that happen constantly. We see money come in and we see money go out. It's a familiar rhythm, a daily dance of numbers that we all participate in, whether we are actively thinking about it or not. This flow of money is the lifeblood of our personal economy. When you bought that coffee, you received a delicious beverage, and the cafe received your money. When your salary was deposited, your employer gave you money in exchange for the work you performed. Paying rent is another clear exchange. You give money to your landlord, and in return, you receive the right to live in your home. It's a two-way street, always. There's a give and a get in every single transaction, a fundamental duality that governs how money moves. This concept is incredibly intuitive when you stop to think about it, yet it forms the very foundation of a system that can sometimes feel overwhelmingly complex. We manage this flow in our heads or through simple banking apps. We check our balance to see what we can afford. We track our spending to make sure we don't run out of cash before the next payday. We might even use a budgeting app to categorize our expenses into things like groceries, transport, entertainment. This is our personal accounting system. It helps us understand our financial position and make better decisions. It tells a story about our priorities, our habits, and our financial health. This simple act of tracking is a microcosm of what every single business, from the smallest corner store to the largest multinational corporation, must do to survive and thrive. But when businesses track their money, they use a special language. They don't just say money in or money out. Instead, you hear these two mysterious words over and over again: debit, credit. It sounds formal, maybe even a little intimidating. You might wonder why there needs to be a special vocabulary for something as simple as money changing hands. Why can't a business just track its cash flow the same way you do with your bank statement? The reason is that the business world requires a much more detailed and robust system to capture the full picture of every transaction, not just the movement of cash. So, why do accountants always talk about debits and credits? It's a question that trips up many people. Students, entrepreneurs, seasoned professionals. It seems like an unnecessary layer on top of what should be straightforward. You made a sale, so you have more money. You paid a bill, so you have less money. Why the need for these specific terms? The answer: a standardized, universal system that ensures accuracy and a complete financial picture. Debits and credits are the fundamental building blocks. This is called double entry accounting. They are the grammar of business, letting everyone read a company's financial story the same way. Imagine building a house without a blueprint. Chaotic construction and confusion. Debits and credits are the blueprint for financial recording. They ensure every action has an equal and opposite reaction in the books. If you receive cash, where did it come from? If you paid an expense, what did you receive in return? This dual-sided approach keeps records in perfect balance. Think of it like a set of scales. Accounting equation: assets, liabilities, equity. The rules of debit and credit enforce this balance and prevent errors and fraud. If the books don't balance, it's an immediate red flag. That self-checking mechanism is the genius of the system. In this guide, we'll demystify the terms. We'll strip away jargon and explain simply. You don't need to be a math genius. By the end, you'll see debits and credits are a powerful tool. Let's get started. Let's start. Most basic definition. In the world of accounting, debit simply means the left side of an account, and credit simply means the right side. That's it. Forget everything you think you know about these words from your daily life. Forget about debit cards taking money out or being in credit with a supplier. In accounting, their primary meaning is purely directional. Debit is left, and credit is right. This is a fundamental rule that never changes, providing a consistent structure for recording every transaction. Think of it as the east and west on a map. They are fixed points of reference within the landscape of accounting that help us navigate where financial events should be recorded. This left side, right side concept is the first step to demystifying the entire system. Accountants use a tool called an account to track the increases and decreases in a specific item, like cash, sales, rent. Every account has two sides, a left side for debits and a right side for credits. When a transaction occurs, we record numbers on one or both of these sides. The words themselves do not inherently mean good or bad, increase or decrease. Their effect, whether they increase or decrease a balance, depends entirely on the type of account we are looking at. This is a crucial distinction that often trips people up, but once you grasp it, everything else starts to fall into place. So, why the specific words debit and credit? They come from the Latin words debere, which means to owe, and credere, which means to entrust. Historically, a debit entry showed what a customer owed the business, while a credit entry showed what the business owed a supplier. Over centuries, these terms evolved into the simple directional labels we use today. While their historical roots can be interesting, it's more practical to lock in the modern definition. Debit is left, credit is right. Chanting this to yourself a few times can be surprisingly effective. This simple geographical distinction is the bedrock upon which all of double-entry bookkeeping is built. Remember the balanced scale we mentioned earlier? The double-entry system demands that for every transaction, the total amount of debits must equal the total amount of credits. This keeps the accounting equation in perfect balance. So if you make an entry on the left side, a debit of one account, you must make a corresponding entry of the exact same value on the right side, a credit of another account. This interplay ensures that every transaction is fully accounted for from two different perspectives. It creates a complete self-regulating system where no value is ever lost or created out of thin air. It is simply moved from one account to another, recorded on its journey. To make this left and right concept easier to visualize, accountants use a simple but powerful tool called a T account. As its name suggests, a T account is shaped like a capital letter T. It's a graphical representation of a single account, showing transactions clearly and organized. Write the account name at the top: cash, sales. The vertical line divides two columns. That visual split is what makes T accounts so useful for learning. It turns abstract ideas into a tangible diagram. Left =sign debit, right =sign credit. This is non-negotiable. Record transactions by entering amounts on the appropriate side. Example: debit to cash. Write the number on the left of the cash T account. Example: credit. Write the number on the right. See all debits and credits for one account in a clean space. Easy to track and calculate balance. Imagine a cash T account. Write cash at the top. When you receive cash, record it on the left, debit. When you spend cash, record it on the right, credit. At period end, figure your cash balance. Add up the debit side. Add up the credit side. Subtract credits from debits. Result: closing cash balance. T accounts give a running, intuitive tally. Their beauty is simplicity. They strip away ledger complexity and focus on the core, the account itself and its two sides, debits and credits. Practice with T accounts builds a solid foundation for double-entry accounting. Trace each transaction through the accounts and watch the balance stay even, before the rules get comfortable. This tool will be your best friend on this learning journey. Now we know that debits are on the left and credits are on the right. But this is where the next layer of understanding comes in. We mentioned earlier that whether a debit or a credit represents an increase or a decrease depends on the type of account. All accounts in a business fall into a few main categories. The most important ones to know for now are assets, liabilities, and equity. Understanding how debits and credits affect these three categories is the key to unlocking the entire system. Let's break it down, one by one, to see how these directional entries translate into real-world increases and decreases for a business. First, let's talk about assets. Assets are things the business owns that have value. Think of cash, office equipment, buildings, and inventory. For asset accounts, a debit increases the balance and a credit decreases the balance. So, when your business receives cash, that's an increase in your cash asset. To record this increase, you would debit the cash account, placing the entry on the left side of the cash T account. Conversely, when you spend cash to buy office supplies, That's a decrease in your cash asset. To record this decrease, you would credit the cash account, placing the entry on the right side. Next, we have liabilities and equity. Liabilities are what the business owes to others, like loans or amounts owed to suppliers. Equity represents the owner's stake or investment in the business. For both liability and equity accounts, the rule is the exact opposite of assets. A credit increases their balance, and a debit decreases their balance. For example, if your business takes out a bank loan, your liability, loans payable, has increased. To show this increase, you would credit the loans payable account. When you make a payment on that loan, your liability decreases, so you would debit the loans payable account. This opposing relationship is the magic that keeps the accounting equation, assets equals liabilities plus equity, in balance. Think about taking out that bank loan. You receive cash, so you debit your cash account, because an asset increases. At the same time, you've taken on a new debt, so you credit your loans payable account since a liability increases. You have a debit on one side and an equal credit on the other. The scales are perfectly balanced. Every single transaction can be broken down this way. Understanding this fundamental duality, how debits and credits work in opposite ways for assets versus liabilities and equity, is the most important rule you will learn in all of basic accounting. Now that we understand the basic mechanics, it's time to expand our view. Beyond the balance sheet, businesses must track performance over time. Two more account types come into play: revenue, expenses. Revenue or income is money a business earns from sales of goods or from services. Expenses are costs incurred to generate that revenue, such as salaries, rent, marketing. These accounts show profitability and are as important as the rest. We expand the accounting equation. Equity rises with revenues, equity falls with expenses. Rules for revenue and expenses link back to equity. Credits increase equity, so credits increase revenue accounts. When you make a sale, you credit sales revenue, showing the business's net worth has grown. On the other hand, expenses reduce owner value, so the rule flips. A debit increases an expense account. Think of expenses as a negative on equity. To increase that negative, you debit. Paying the electricity bill? Debit utilities expense. That reduces net income and consequently equity. Now the fundamental rules. Assets: debit up, credit down. Expenses: debit up, credit down. Liabilities: credit up, debit down. Equity: credit up, debit down. Revenue: credit up, debit down. These are the golden rules of debit and credit. Master the logic, not dozens of scenarios. These 5 principles let you record any bookkeeping transaction, the universal framework for financial accounting. Remembering which accounts are increased by debits and which accounts are increased by credits can be tricky at first. Luckily, accountants have developed some handy acronyms to make this process much easier. One of the most popular and effective memory aids is the word dealer. This simple acronym helps you group together all the account types that are increased with a debit entry. A simpler way to use it is to focus on the first half, DEA. D stands for dividends or drawings. E stands for expenses. A stands for assets. Dividends, expenses, assets. Their normal balance is a debit balance, and you increase them with a debit. On the flip side, we have the LER part of dealer, L, liabilities, E, equity, R, revenue. These accounts have a normal credit balance and are therefore increased with a credit. Another popular acronym that focuses just on this group is ALLOY. A, assets, L, liabilities, O, owner's equity. In this version, assets are on their own, while liabilities and owner's equity are grouped together. The rule is that liabilities and owner's equity behave the same way. They are increased by credits. Whichever acronym clicks better with you, dealer, ALLO, or another one, the goal is the same: instant mental association. Using these acronyms can feel like a superpower when you're starting out. Instead of pausing and trying to puzzle out the logic from scratch, you can simply ask yourself, what type of account is this? Is it an asset? It's in dealer, so debit to increase. Is it a liability? That's in the LER group, so credit to increase. Is it an expense? That's in the DEA group, so debit to increase. These tools bridge the gap between theoretical knowledge and practical application. making the process faster, more accurate, and much less intimidating. They help you build confidence as you practice and internalize these fundamental rules of accounting. Now that we have the theory and the rules under our belt, let's put them into practice. Seeing how these concepts work with real-world examples is where the understanding truly solidifies. For our first example, your company buys essential office supplies, paper, pens, printer ink. They pay immediately using cash. The total cost is $100. Let's analyze. Identify affected accounts. First, the business acquires supplies. Supplies are an asset. Office supplies account is affected. Second, the business pays with cash. Cash is an asset too. Accounts involved, office supplies, cash. Both are asset accounts. Determine if they increase or decrease. Office supplies increased by $100. Cash decreased by $100. Now we apply the rules. For assets, a debit increases balance, a credit decreases balance. Office supplies is increasing. Debit office supplies $100. Cash is decreasing. Credit cash $100. Journal entry. Debit office. Supplies $100. Credit cash $100. Debits equal credits. $100 each. The accounting equation stays perfectly in balance. To make that first transaction even clearer, let's visualize it using the T accounts we learned about earlier. This will help you see the left side entries and the right side entries in action. Based on our analysis, we need to debit the office supplies account to show an increase in this asset. Remember, debit means left side. On the office supplies T account, write $100 in the left-hand column. Next, record the other half. We need to credit the cash account to reflect a decrease in cash. Remember, credit means right side. On the cash T account, write $100 in the right-hand column. Now stand back and look at the two T accounts. $100 on the left of office supplies, $100 on the right of cash. We have a debit and a credit equal. This is double entry bookkeeping in its simplest form. We haven't just recorded that we spent money, we've recorded what we got in return. Let's move on to our second practical example. This time, let's look at a revenue-generating activity. Imagine your business has completed a service for a client and has just received a payment of $500. The client pays you in full with a direct bank transfer. First, identify the accounts. The business is receiving $500 in cash, so the cash account is affected. Cash is increasing. Why did the business receive this money? It earned the cash by providing a service. That income is recorded in service revenue. Cash, an asset, is increasing by $500. Rule for assets, debit to increase. So debit cash for $500. Service revenue is also increasing. Revenue is in the LER group, increased with a credit. So credit service revenue for $500. Formal journal entry coming up. Debit cash $500. Credit service revenue $500. Total debits $500. Match total credits $500. Books balanced. For our final example, let's tackle a financing activity. Imagine your business needs a bit of extra capital. It successfully secures a loan from a bank. The bank deposits $10,000 directly into your business's bank account. First, let's identify the two accounts affected. The cash account is involved and is increasing. That cash came from the bank as a loan. It's borrowed money the business must pay back. That obligation is a liability, called bank loan or loans payable. Next, apply debit and credit rules. Cash and asset increased. To increase an asset, debit it. Debit cash $10,000. Bank loan, a liability, also increased. Liabilities are increased with a credit. Credit bank loan $10,000. The complete journal entry. Debit cash $10,000. Credit bank loan $10,000. The total debits equal the total credits. The accounting equation remains perfectly balanced. As you begin your journey, it is completely normal to make a few mistakes. One of the most frequent errors is mixing up the rules for different account types. Another very common mistake is simply reversing the entry. You might accidentally credit cash and debit service revenue. This single error throws the balances of both accounts off completely. A third pitfall is forgetting about the second half of the transaction. This is the cardinal sin of double entry bookkeeping. This mistake immediately breaks the fundamental accounting equation. Finally, many people get confused by the everyday use of the words debit and credit. Trying to map banking conventions directly onto business accounting rules without understanding the change in perspective is a guaranteed recipe for confusion. Now that we know what to watch out for, let's arm ourselves with some pro tips. The number one tip is to practice, practice, practice. Another powerful pro tip is to always use acronyms like dealer. Before you make any entry, say the acronym in your head and identify which category your account falls into. A third great tip is to always think in terms of the accounting equation. Assets equals liabilities plus equity. For every transaction, think about how it affects this fundamental equation. Finally, try to personify the accounts. Think of the cash account as a wallet. Think of the loan payable account as a person you owe money to. Creating these simple, relatable stories can make the abstract rules feel much more concrete and intuitive. We have come a long way on our journey together, from the simple act of buying a coffee to recording complex bank loans. Today, you have unlocked the core logic behind debits and credits. We have seen that these are not mysterious or intimidating terms, but simple directional tools. Debit for the left, credit for the right. You learned that their effect depends entirely on the type of account we are looking at. You now possess the powerful tools to analyze any financial transaction. You have the T account to visualize the flow of value. You have the invaluable dealer acronym to remember the rules effortlessly. You saw how every debit has an equal and opposite credit, a beautiful symmetry that keeps the accounting equation true. You are no longer on the outside looking in. You can now read the story the numbers are telling. You have taken a huge step toward financial literacy. Whether you are an aspiring accountant, small business owner, student, or just someone who wants to better understand money, this knowledge empowers you to make smarter decisions and engage with business on a much deeper level. If you found this explanation helpful and you want to continue making complex financial topics simple and clear, please consider subscribing to our channel. Don't forget to hit the notification bell so you won't miss our next video. We have so much more to share with you. Thank you for joining us today, and we look forward to seeing you in the next lesson as we continue to build your financial fluency together.